How did the 1986 Tax Reform Act reshape income tax? Imagine a tax system that was once full of complicated rules, high rates, and many deductions. Now picture it becoming simpler, with lower rates and a broader base. That's what happened in 1986. This law changed the way income tax worked across the United States. It was a major shift that affected both federal and state policies. The act cut the top individual income tax rate from 50% to 28%. It also reduced the number of tax brackets from 15 to just 4, making the system easier to understand. The lowest rate was raised from 11% to 15%, which meant fewer people paid very low rates. This change made the tax structure more balanced and less confusing for taxpayers. Another big change was the elimination of many deductions and loopholes. For example, the act removed the deduction for state and local taxes paid, which meant taxpayers could no longer reduce their federal taxes by deducting these payments. This made the federal tax system more straightforward but also increased the tax burden for some people paying high state taxes. The law also expanded the standard deduction and personal exemptions. This helped many low-income taxpayers pay less or no federal income tax at all. It also introduced new rules for income from investments and business activities. For instance, it limited passive activity losses and repealed special treatment for long-term capital gains, broadening the tax base and promoting fairness. The act strengthened the alternative minimum tax, which was designed to ensure that high-income earners paid at least a minimum amount of tax. It also imposed stricter rules on corporations, like limiting net operating loss carryforwards after ownership changes and increasing reporting requirements to prevent tax shelters. From a state policy point of view, these federal changes had big effects. States often follow federal definitions for income and deductions. When federal rules changed, states had to adjust their own tax laws accordingly. Some states lost revenue because taxpayers could no longer deduct state taxes from their federal returns. Others had to rethink their tax brackets and exemptions to stay aligned with federal standards. The act also impacted estate and gift taxes. It revised rules for generation-skipping taxes and allowed deductions for conservation easements. These changes influenced how states managed estate taxes and planning strategies. Overall, the 1986 tax law reshaped income tax by making rates lower and more uniform, broadening the tax base, and removing many deductions. It affected how both federal and state governments collect taxes, and it changed incentives for investment and business. States had to adapt their laws to fit the new federal framework, which in turn influenced public finance and policy decisions across the country.